This is one question that I get a lot from new trader, even people who've been trading for years. They still don't know how to choose the right option contract. So in this video, it's gonna be a small guide about how I choose the option contract, and we're not gonna waste any time and we're gonna jump into it. The first thing we have to understand here is option contracts are asset based on time. If the asset is based on time, that means we need to pay attention of the time we're using with our option. So every option contract has what we call an expiration date. And choosing the right expiration date is really important when trading options. Because if you're trading and you're choosing the wrong expiration date, it's really easy to actually lose money if you don't know what you're doing. The expiration date choice is one of the most important factors for an option trader. So let's talk about how we need to actually choose an expiration date. What kind of process thinking, right? Well, how can we decide which expiration date we need to focus on and we need to choose? So there's three main categories that I personally go through when I'm trying to actually choose my expiration date for my contract. The first one is the short-term category. So when taking a contract, we actually have a short-term expiration. You have to understand that that contract can be considered as a high-risk trade. And personally, when I use this expiration date, I'm expecting to actually catch some fast move. I'm not trying to actually hold a contract for too long because those contracts are more likely to expire worthless. As time goes, the option contract lose value because the asset is based on time. So it's really important to understand that. So when you're trading a short-term contract, the contract expires within a week, within less than 5 days, 7 days. You need to understand that you don't want to stay in for too long. That's the first thing. And the second phase, when you do the expiration date, is the medium term. So the medium term is between 2 weeks to 6 weeks, right? About a month. And this is pretty much a good balance between a risk and reward because it actually give you more time to actually give your trade to work on your favor. Compared to the short term, you need to be really accurate on the timing to actually get it. But the medium term is more forgiving because it can actually go against you and the contract value wouldn't be hurt as much because you still have time. So the option contract has something called time value. So on the short term, the time value is really small. In the medium term, it's more available to you that if the trade goes against you, if the option contract wouldn't lose value as fast, right? So on the short term, the contract lose value really fast, and the medium term, you actually have more time to actually have your trade to work on your favor. And the third one is pretty much long term, which is pretty much more than 2 months. It's usually more expensive, but they are usually less risky because again, the time value for those option contracts are way more higher. So those are pretty much ideal for swing traders and investors. So if you're trying to catch a trade for long term, 2 months and more are usually best for option contract. That's when you're trying to catch a big move and you're not trying to cash out right away, right? You want to be really patient of that trade. But for the short term, those are pretty much really fast paced. So for people who actually day trade and scalpers, and also if you actually a really, really short term trader, you have to be really good taking swings and executing at a higher level. For example, I like to actually overnight swing. So when I overnight swing, in trade that actually go overnight, I'm mainly taking short-term expiration date because those are trade I'm trying to actually get in and get out really fast. I'm not trying to hold it for long. If I'm trying to hold a swing for a long time because I am a swing trader myself, I'll definitely try to look for the medium term if I'm trying to still cash a quick move, but I need more time for the trade to actually play out. I'll probably focus on the medium term. And if I'm trying to catch the bigger move for a long term, the long term option contract, more than 2 month expiration date, those are the perfect one because they're less risky and I don't have to worry about it too much because I don't have to actually always monitor the trade. He has more time to actually go through it. Now, let's go over one of the most important pieces of the puzzle, which is actually choosing the strike price. So everybody watching this video should be familiar with the strike price. And it's really important to actually be able to actually choose the right strike price. And when choosing a strike price, you have three different choices you can make because a strike price can be either in the money, out the money, or out of the money. All right, so ITM, ATM, or OTM. And those are two different ways to actually choose a strike price. So a strike price can be in those three categories. All right. And as the option trader, it's your responsibility to know which one you want to choose when choosing your contract. In the money, the contracts are more expensive because they have more higher entry value and they move closely with the stock price in general. So these right here are the safest one, and that's why they're more expensive because they're in the money. They are something what we call intrinsic value. The second option you have is choosing a contract being out of the money, which is more balanced between price and movement. And those are really good if you're a beginner, especially for a day trader as well at the money. And out of the money are the more common one I see new traders tend to take because they're more cheaper. But the thing is, the cheaper, the riskier they get. Right? And because they actually need some big moves to become more profitable. So in terms of probability on which one are more profitable, this one has the lowest probability, and this one has the highest probability to actually be profitable. All right. And but in general, actually, let me go back. So if you don't know what in the money mean, out the money or out the money means, so let's give an example really quick. So let's say Apple, all right, let's talk of Apple currently trading at $50. When choosing your contract, you're gonna have different options. You're gonna have like a strike at 51, 52, 53, and you're also gonna have 49, 48, 47. So every contract below the current price, this will be here in the money. All right. And just near the 51, so if you have 50 or near the current price, if you either 50 or 51, all right, this will be at the money because it's really close to where the stop price is. And when we go further out the money, all right, I would say even this right here can be considered at the money as well. But after two strike, we way more out of the money. All right, which is like a bit more risky. And the more out of the money you go, the more risky it gets in general. So just to actually summarize it, in the money right here, this is below the strike price. At the money is more close, less equal or less near the strike price, and out the money is pretty much way above the strike price. All right. So we talk about expiration date. We talk about strike price. Now, one of the other factors that we need to actually know and understand when taking an option contract, it has to be liquidity and volume. Those are really, really, really important if you're trying to actually make money in the market trading option. So let's talk about it really quick. When talking about liquidity and volume, something we need to know about is the open interest. So the reason why you want to actually enter a trade with a higher open interest is because you actually make it easy to actually enter and exit the trade. So open interest means that the trade has more liquidity. So it's more easy to actually find a buyer or a seller for your contract. And open interest simply means how many contracts are still available, still open in the market for this specific strike price or this specific contract you're looking at. So the higher, the better. And the second part is going to be volume, right? So the higher the volume, the better liquidity. So if there's volume, that means there's a lot of transactions happening in this contract, and you want to see that. So if you want to look at the contract and you see the open interest is low and the volume is low, you want to stay away from it because if you enter, you're going to have a hard time to actually get out. But if you see the open interest being high and the volume being high, that's something you want to actually pay attention to. That's a contract you want to take because if you only enter, you're pretty much confident that you're going to find a buyer at the other end of the spectrum to actually sell your contract to. And that's what you want. It's pretty simple. And the last part is going to be bid and ask spread. The one thing about bid and ask spread is like what I noticed, the lower the open interest, the wider the bid and ask would be. That's why it's really important to actually focus on contract who have high open interest or high volume because the bid and ask will be also affected. If you have a contract, let me actually give you guys an example of the bid and ask. So when buying the contract, you also see sometimes the price will be here. The mid price can be, let's say the mid price might be at $2, right? And the ask $2, the ask will be at let's say at 205, all right? And maybe the bid will be at 195. So this right here, right, it is a good bid and ask because it's not that wide. But if you want to take a contract and the price, let's say, is at $2 and the ask is at 230, but the bid is at 185, these are pretty much wide. And this, when you take that, they're more risky because you can actually easily have a bad fit because the mid price at 2. Now you can actually have like the wide is 2, like because this is almost like 30 cents, $30 difference. This is about a $15 difference. All right. And it's really tough to actually have a good fit because it actually move a lot and that will create volatility in the premium price. So it is really important to actually understand this and take this in consideration when choosing your option contract. Another thing actually you want to consider is the implied volatility. The implied volatility is really important because it actually showcases about like what kind of volatility you can expect in a contract. So the higher the volatility, the higher the move can actually happen in the stock. And also implied volatility affect the option price itself. So the lower the volatility, the cheaper the option will be. Right? And big move that you get on the lower volatility will actually give better profit. The higher the IV, right, the more expensive the premium is. The lower the IV, the cheaper, all right, the premium will be. So when if you enter, all right, a option contract, we have low IV. If you have a big move, that low IV will go from low to high. So that means you're gonna have better profit because when the high V go up, the option contract will take a big jump, and that will give you a better profit. So I definitely love to see a low IV contract, which if the stock will potential to actually make a big move. When that happens, those premium, those contracts get high in value, and that's where you can have a big percentage return. All right, I love to see that. And the high heavy as option contract being expensive, and there's something called volatility cost that can actually hurt your trade. And you can definitely see that when we have earnings. During earnings, pay attention. You will see the contract having high IV more than 100% high V or more than 200% high V. Because during earnings, you can expect the stock to actually make a big move, and there's way more eyes on those contracts. People are more interested to actually both buy those contracts. Something I didn't mention is the higher demand we have in the option contract, the higher the high V becomes. All right. So definitely pay attention to that. But well, let's say after earnings, if the move didn't happen the way it's supposed to, so let's say you have Apple, we have supposed to have earnings, and the expected move on Apple should be 7%. If you only have a 20% move, we're gonna have a volatility curve. So the high V will go from high to low premium, and low high V means cheaper premium. So the contract will go from like being expensive to cheap. So if you in that trade, now you buy high, you bought the contract at a high level, and now you have to sell it at a low level, and you don't want that. So pay attention to that. So when taking the trade during earning, that's something you need to pay attention to. If the high V is like over 500, you definitely want to do that. You just like stay away. It's not worth it in general. That I usually don't trade it for sure. Now, another important factor when choosing your option contract is actually be able to match your contract to your strategy. All right, it's really important that phase because depending on the strategy, your contract choice will be different. We always talk about adding money in the money. So if you're a day trader, you want to look for liquidity contract, which is add the money or in the money contract with tight spread, right? Because you remember, you want actually your move to actually happen fast because you're a day trader. You actually buying and selling on the same day, and you want to actually be either in the money or out of the money. You don't want to be out of the money, too much out of the money because those are the more risky one. So you don't want to get there, even though they're cheaper. If you're a swing trader, all right, you want to choose contract with at least 2 or 4 weeks as expiration date. Those are really good. You can still choose like add the money or eat the money contract. And because sometimes you also choose slightly out the money, but your expiration date needs to be meaningful where maybe you think the stock can make a big move to get out that much out of the money, but it's still risky. And the last part, right, it is long-term traders. So this right here, I forgot to actually add scalper as well. But day trader and scalper doing the same thing. They buy and sell the same day. And long-term traders pretty much consider leaves. You pretty much start trying to buy like 6 months out, which much like your contract tend to deal with less time decay, which is one of the quick in option. So definitely this is for my long-term play. So those are really good. So if you're trying to actually be like almost be in investor more long-term vision in a stock, you should definitely consider taking leaves 6 months plus, even 1 year. Those are definitely worth it. You should buy it and you forget about it. So final tip. What you need to do when choosing the option contract if you're new as a trader, as option trader, you definitely try to start small and learn about it and learn all those different factors and see how they move in general. So you need to actually choose, right? Remember, choosing the right contract, take practice. Right? The second part, if you ensure, you need to start with paper trading. There's nothing wrong with that, or just like paper trading to see how it goes so you don't make dumb mistake. And the last part is pretty much you have to learn before risking your money. And that's something people are not really, they don't really think about that. It's really important to learn. If you pretty much in my training community, we pretty much learn as we earn. While we earn while we're learning. And that's the main thing about being in a community, because you can always ask questions to people who have been doing for so long and get the feedback. And if you're stuck, you don't understand something, feel free to ask questions in the community, and we can actually answer you and actually give you clarification on whatever you're confused about. Pretty simple. So let's talk about some key takeaways. You need to make sure to actually match your expression to your risk tolerance. Second, are the money or slightly in the money strike are best for beginners traders because they're less risky. High volume and tight spread are really, really important when choosing your contract. Also, high open interest too. And definitely be aware of implied volatility. Again, the higher the volatility, the more expensive the contract is. Definitely be aware of that. And again, if you don't know what you're doing, practice with paper trading first is really important. So this is what I have here for today, right? Learning how to actually choose the option contract. And I hope this is helpful. If it's helpful, make sure you let me know. If you have any question, make sure to let me know as well. If you like this kind of video, make sure to subscribe and like. There's way more video coming, and I'm looking forward to actually share all those knowledge that I've been learning for years with you guys for free on the YouTube channel. Thanks for watching, and catch you guys later.